Welcome back to the deep dive. If you have ever tried to trade on a decentralized exchange, a DEX, you probably know the feeling.
Oh,
That feeling of hitting submit on your transaction, holding your breath, and then realizing that some invisible entity, maybe a sneaky bot, just made your expected return, well, a lot worse.
right. DeFi promised us this, true financial freedom and transparency.
But for a lot of people, it just delivered frustration and these hidden costs.
And that pain point is exactly why we are diving deep today into Hashflow, or HFT.
A decentralized exchange that basically looked at that whole landscape and said,
It can do this much better.
and they aren't just tweaking the existing model, they're trying to replace the fundamental engine of decentralized trading.
Absolutely. Our mission today is to unpack a really comprehensive analytical report focused entirely on Hashflow's innovative approach. It's an approach that directly challenges the AMMs, the automated market makers, that most of us are familiar with.
Like Uniswap.
Exactly, like Uniswap. We need to understand the technology, specifically this request for quote, or RFQ mechanism, and figure out how Hashflow actually guarantees prices.
And crucially, why that guarantee is the thing that's attracting the biggest, the most professional institutional players in crypto right now.
We are talking about the firms that move billions daily.
Okay, let's unpack this by starting with the diagnosis. Before we get to Hashflow's solution, what are the actual chronic headaches people face on those older DEXs? The sources say Hashflow was built to solve a DeFi trilemma.
The trilemma is the perfect word for it because it really outlines three major structural drawbacks that plague those traditional AMMs.
So hit us with the first one.
The first is slippage. This is probably the most familiar problem for anyone who's tried a slightly larger trade.
Right.
Slippage is the difference between the price you expect when you click confirm and the actual, almost always worse price you get when the trade finally goes through on the blockchain.
And the bigger you trade, the worse it gets.
The more devastating it becomes. For big institutional orders, slippage isn't just a nuisance, it's a huge operational cost.
Okay, so your own order is pushing the price against you. What about the people supplying the funds for these platforms?
That brings us to the second pillar of this trilemma, impermanent loss, or IL.
Oh, yes.
This is a risk that's shouldered entirely by the liquidity providers, the LPs. It's basically the difference in value between just holding your assets in a wallet versus locking them in a liquidity pool.
So you can actually lose money by providing liquidity even if the token prices go up.
You can. It's a constant and often unpredictable drain on capital.
And the third problem, this is the one that really feels unfair, is the robotic exploitation, the infamous MEV.
Exactly. The third, and maybe the most notorious problem, is maximal extractable value, or MEV.
Can you just give us a quick practical example? Because MEV can sound pretty abstract.
For sure. The most common form is called a sandwich attack. When you submit a trade, let's say buying token X, it first goes into a public waiting area.
The mempool.
The mempool, the MEV bots see your pending order, and they realize it's large enough to move the price.
So they jump in front of you.
Instantly, the bot makes an identical small purchase, that's the front run. Then your large order executes, pushing the price up, and the bot immediately sells its tokens back for a profit. That's the back run.
You're literally sandwiched. And you get a worse price, well, the bot gets a guaranteed profit.
A profit extracted directly from your trade.
So the old way is kind of rigged against anyone trading with real size. If that's the problem, the goal for Hashflow has to be getting rid of that uncertainty.
Precisely. Hashflow's whole goal is to offer a trading experience that is predictable, safe, and efficient enough to rival a centralized exchange.
A CeFi platform.
Right. But, and this is key, while still maintaining the self-custody benefits of DeFi. Their main audience isn't just a casual user. It's sophisticated traders and institutions who just cannot tolerate being exploited by slippage or MEV.
That makes perfect sense. For professional capital, execution is everything. So if the traditional DEXs are flawed because of that simple math formula, what is Hashflow's big idea? How is it so different?
The big idea is a total paradigm shift. Hashflow just throws out the AMM price curve and replaces it with a direct request for, quote, mechanism, an RFQ.
Okay, let's use that analogy from the sources.
Yeah.
If we put the two systems side by side, what do they look like?
Okay, so think of the traditional AM like Uniswap as a public vending machine. That vending machine is stocked with two assets, and the price is set by a very simple, very public mathematical formula, a curve. You put your money in, It spits out the tokens based on that formula.
And everyone can see you walking up to the machine and what you're about to buy.
Exactly. And the machine has no idea what the real price is on Binance or Coinbase. It only knows its own internal math.
Right. So what's Hashflow?
Hashflow is like walking into a private office and calling a professional broker-dealer.
Okay.
You, the trader, ask for a trade. You say, I want to swap $5 million of ETH for USDC.
And the broker doesn't use a simple formula.
No, they use their own sophisticated proprietary real-time pricing models. They're pulling data from everywhere. And then they give you a direct, guaranteed, firm price quote before you commit a single dollar.
So it's the difference between a simple algorithm and professional expertise. And that must open the door to way more complex trading, right?
It does. And this is vital for their long-term vision. The sources say their mission is to become the liquidity layer for DeFi.
So way beyond simple swaps.
Way beyond. They believe this RFQ structure is essential because it can support complex financial products that AMMs just can't price efficiently. Things like on-chain options, structured products, even crypto ETFs.
You need a guaranteed price for that stuff to work.
You absolutely do.
That's a powerful vision. But I have to ask, how can they guarantee a price in a trustless environment? If the pricing is happening off-chain somewhere, how do I know I'm not just getting ripped off by that broker?
That's the core tension, right? And they solve it with a really elegant hybrid approach.
Yep.
Let's walk through the steps because it's actually pretty simple.
Lay it up for us.
Step 1. You, the trader, you just initiate a swap request in the Hashflow app.
Easy enough.
Step 2. That request is instantly, and most importantly, privately sent off-chain to a network of vetted professional market makers, the PMMs.
So only these authorized brokers see my request.
Exactly. And they use their secret sauce algorithms to find the absolute best price they can offer you, often using arbitrage from centralized exchanges.
So the hard work happens quickly and privately, away from the MEV bots.
Precisely. Now, step 3 is the most critical part. The PMM provides that best quote and then uses their private key to cryptographically sign it.
The signature.
That signature is the binding, verifiable digital contract. It guarantees the price. There are no takebacks, no changes, no matter what happens in the market a millisecond later. The signature is the promise.
I see. So the guarantee is verifiable on-chain.
You got it. Which brings us to step 4. That signed, guaranteed quote is sent on-chain to the Hashflow smart contract for execution. The contract verifies the PMM signature, confirms the funds, and completes the swap.
So they keep the heavy lifting, the price discovery off-chain for speed, but the actual settlement, the asset exchange, is secure and decentralized on-chain.
It's a very deliberate balance, and because that quote is generated privately between you and the market maker, it never hits the public mempool as an order that can be exploited.
That's the MEV protection right there.
That's the whole foundation of it. You get the price you signed for every single time.
That explanation is great, but let's bring it back to the listener. What does this RFQ system actually mean for me when I'm making a trade? What are the concrete benefits?
You get 3 major practical advantages that directly solve that DeFi trilemma we talked about.
Okay.
First, and most obviously, zero slippage. Since the quote is cryptographically signed and guaranteed by the PMM, it's a hard promise.
The price you see is the price you get.
Always. Whether you're trading $1,000 or $10 million, that predictability is, well, it's revolutionary for anyone trading with size.
And the second benefit takes care of our sneaky robot friends.
Right. Complete MEV protection. Like we said, because the quote is private until the moment of settlement, it just shuts down front-running and sandwich attacks completely.
The bots can't exploit what they can't see.
And they can't break the signed guarantee. It means better prices for everyone.
Okay, and there's a third one that's huge for anyone working across different blockchains.
Yes. Seamless cross-chain swaps. Hashflow offers native cross-chain swaps without you having to use those external, often vulnerable bridges or deal with complicated wrapped assets.
Hold on, I need to understand that. A cross-chain swap usually means bridges and multiple transactions. How does Hashflow make it one trade?
It's the professional market makers again. They do all the heavy lifting.
How so?
Let's say you want to swap asset A on Ethereum for asset B on Polygon. The PMM essentially takes your asset A on Ethereum and then simultaneously delivers asset B to you from their own private liquidity on Polygon.
Oh, so they handle the balancing themselves internally.
Exactly. They take on the risk. For you, the user, it's just a single guaranteed transaction across 2 different ecosystems.
Wow, that simplifies a really risky process.
Right.
So are people actually using this? What do the adoption metrics look like?
The sources show huge, sustained adoption. Cumulative trading volume is now over $25 billion.
25 billion.
Wow, and over 170,000 unique wallets have used the platform, so it's not just a niche product.
Now, you mentioned institutions. We usually look at TVL total value lock to measure a DEX's strength. But the source said Hashflow's TVL is misleadingly low, only around $680,000. Why is that?
That is such a crucial point to understand, and it speaks to the architecture. In a traditional AMM, all the liquidity has to be locked in Public smart contract.
Right, for the math to work.
But with Hashflow's RFQ model, the PMM's liquidity is not locked up. It stays on their own private efficient wallets until the exact instant of a trade.
So it's liquidity on demand.
Exactly, which means TVL is a completely meaningless metric for Hashflow. Its strength is measured by its massive trading volume, not by idle capital sitting in a pool.
Let's pivot to the HFT token itself. Given this reliance on a few big market makers, how does the token actually create value for the community and keep people engaged?
The HFT token has two main roles that are linked together: governance power and financial value.
Let's start with the value. How does it make money for holders?
So a really crucial update was the fee switch. This means that 50% of all the trading fees the protocol collects are distributed directly to people who stake HFT.
Okay, a direct reward. And the other 50%?
That's used for token buybacks and burning.
So the token's value is directly tied to the platform's success. The more volume, the more rewards, and the more tokens get burned.
Exactly. It's a strong feedback loop. Now, for governance, it uses the vote escrow model, the V model, which you see with protocols like Curve.
Lock your tokens for longer, get more voting power.
You got it. It incentivizes long-term commitment.
But they seem to have taken governance a step further. I saw a note about something called the Hashverse, developed with a Hollywood agency.
They did. It's a unique gamified DAO platform called the Hashverse, and it was specifically designed to fight voter apathy, which is, a huge problem in DeFi.
That's hilarious. A Hollywood agency for DAO governance. How does it work?
It turns governance into an interactive game. Users stake HFT, and then they complete quests. Things like voting, referring users, making proposals. In return, they earn rewards like more HFT or exclusive NFTs.
So it's trying to make governance fun instead of a chore.
It transforms a typically dry technical process into something engaging and competitive, which builds a much more active community.
Okay, we've established Hashflow is fast, it's efficient, it's safe from bots. But that efficiency has to come at a cost. Let's get into the critical trade-offs and risks. This must introduce some serious compromises, right?
It absolutely does. And that efficiency comes with a fundamental trade-off in decentralization. The core issue is the fundamental centralization risk.
I mean, for a DeFi protocol, isn't it relying on a handful of identifiable firms like Jump Crypto, Wintermute, GSR, kind of against the whole point of permissionless finance?
That is the central criticism. The protocol is critically dependent on this limited permission set of professional market makers. They're vetted and authorized by Hashflow.
So what happens if they just stop?
If those few key players stop providing liquidity or quoting prices for whatever reason, regulatory, technical, whatever, the platform basically stops working.
It's a single point of failure.
It's a significant vector of centralization and a single point of failure. The sources are very clear about that. It is the price you pay for guaranteed efficiency.
That is a heavy price. What about their technical security reputation?
That's another area of concern. We have to mention the security incident in June 2023. It led to a loss of about $600,000 across 5 different blockchains.
Ouch.
Now, the investigation concluded the vulnerability was in an out-of-audit scope contract, so it was outside the main vetted code, but
It still happened.
it still happened. And it highlighted some critical flaws in their internal security and deployment processes. It was a serious blow to confidence.
Okay, let's talk regulation, because this is fascinating. Does having these identifiable market makers make them an easier target?
It creates this incredible regulatory paradox. On one hand, yes, absolutely. The RFQ model, with its known professional counterparties, is an easier target for regulators than a totally anonymous AMM.
Regulators know who to call.
Exactly. So why would an institution risk using it?
Yeah.
Because that risk is also their biggest opportunity. The sources suggest Hashflow's structure could allow it to implement compliance measures like KYC and AML checks at the market maker level.
Something a purely decentralized AMM just can't do.
It's practically impossible for them. This means Hashflow is uniquely positioned to attract huge traditional finance institutions that are looking for a compliant, secure way to enter DeFi. They turn the centralization risk into a regulatory advantage.
So they're selling the trade-off. We're a bit centralized, but that means we're compliant and safe. Smart. But I'm guessing they're not the only ones with this idea anymore.
They're not. The competitive pressure is really mounting. Other DX giants, especially aggregators like 1inch, are now implementing their own RFQ systems.
So Hashflow's main innovation is becoming a commodity.
It threatens to. The fight for that professional order flow is heating up across the entire DeFi landscape.
Okay, we've covered the problem, the brilliant solution, the benefits, and the very real trade-offs. If we had to give a final verdict on Hashflow for our listener, what is it?
Hashflow is a technologically advanced institutional-grade DX that delivers zero slippage and MEV-protected trades by making a conscious, and I'd say necessary, trade-off.
Which is?
It is exchanging pure, permissionless decentralization for guaranteed execution efficiency and institutional compliance capability.
So for traders who value price certainty above all else.
It currently offers a best-in-class product.
That is very clear. Now give us that final provocative thought to chew on, something that sticks with us.
Consider this. The sources repeatedly point out that Hashflow's main liquidity providers, firms like Jump Crypto, Wintermute, and GSR, are also its primary investors. They're embedded in the governance.
Yeah, so they aren't just betting on Hashflow's success.
They're not on the sidelines. They are actively building a more profitable and risk-managed ecosystem for themselves inside of DeFi.
Right.
So this raises a fundamental question about the future of finance. Does the long-term success of an efficient decentralized exchange ultimately rely on aligning the self-interest of centralized financial powerhouses, effectively making DeFi work as a profit center for CeFi?
If you found this deep dive interesting, please take a moment to like and subscribe to the channel. We do all the complex research, gathering information from dozens of sources, so you don't have to.
Keep diving deep into the topics that matter, and we will catch you on the next one.